Hey there traders, this is Shane from Trade Tactics, and today I'm going to go over one of the ways that option delta can save your bacon. Now this is the first part of a three-part series, so there should be two additional videos after this one, so be sure to look for them for two additional ways that option delta can really help you out in your trading. Now if you're not familiar with option delta, delta is one of the option Greeks. You have delta, theta, gamma, vega, and delta is one of the most important ones. It determines how much an option's price is going to change for every $1 change in the underlying. And so we can use this in a lot of different ways to help to balance our positions, to see what probabilities are. And what we're going to figure out, we're going to look at today is how option delta can help you hedge a position. Now, a hedge essentially is an ancillary position to one that you already have that will help offset some risk. Now, there's no such thing as a perfect hedge. You're not going to be able to balance out a position 100% all the time. If you don't want to be in a position, then just exit. That's your ultimate hedge, is just to exit the position to get out. But if you want to offset some downside risk, maybe you have earnings coming up and you don't want to get out of a stock that you might be in, and you just want to take a little bit of the edge off, then you can hedge with an option. And delta can help you figure out how big of a hedge to create, and by using delta, it'll tell you which option to purchase. Now, typically, you might want to offset maybe say 30% of your downside risk. So the thing about stocks or equities or ETFs is that they have a static delta, so that $1 change in the stock, $1 change in the stock price represents a $1 change in the stock price. So they're static. The delta is one for one. So one share of stock carries a delta of 1. So we can use this in conjunction with options, which do not have a static delta. They have a soft delta, which changes with the price of the stock. So depending on how in the money or out of the money an option is with regards to the current price of the stock, the delta will change based upon that. So what we can do is let's just take a quick look here. Now, if you're not familiar with the option Greeks overall, why don't you leave me a comment down in the comment section and say that you're interested in knowing more about that, and then maybe we can do a series on the option Greeks and get really in detail on what each of the option Greeks is, how they work, and what they're good for. But for now, we're going to assume you know what delta is at a very basic level at least, and we're going to take a look here at, this is the Thinkorswim simulated trading account. So if you're not familiar with Thinkorswim, you can download this particular application for free, and it is one of the best platforms for trading options that's out there. So you can download it for free. You can get a simulated trading account for free. Now, if you don't have a funded account with them, then you may be on delayed data, 20-minute delayed data, which, if you're just kind of testing out positions in the evening or simulating some positions in the evening, that's not a big deal. If you want to actually do some simulated trading during the day, then you need to contact them and ask for real-time data, and they'll turn it on for you. Their supports, they just flip a switch and you got real-time data. I believe you have to have a funded account in order to get that, but you may try otherwise as well. Anyway, great platform, download it. If you're not familiar with the Analyze tab here, once again, if we want a tutorial on that, leave me a comment down below, and I'll see what I can do to hook up a tutorial on this Thinkorswim, the Analyze tab here, which is extremely powerful and helpful for managing your positions. So let's start off with a position here. Let's assume that we have 100 shares of Apple stock. Now we know that that, so I just clicked the ask here once. That added 100 shares of Apple stock down here into the simulated position area here, and I can change this up or down, obviously. So if we all know that an option is controls or relates to 100 shares of stock. So if I buy an option, it's like controlling 100 shares of stock. So so we're gonna practice here with 100 shares. We assume we have just 100 shares for this particular example, and we notice here that in the price slices section, which is, this is like a risk array, and it lays out, it puts out all the Greeks for you, tells you what your P&L is for the open and for the day. And we'll notice that this 100 shares of Apple carries a delta of 100. That's the static deltas of a stock, 1 for 1. So like if I decrease this by 1 to 99, 99, we'll see that we have 99 deltas. So each share of stock comes with 1 delta. Okay, so we're going to have 100 deltas here. That just say the scenario that earnings are coming up, and we were a little bit nervous that the stock might drop due to earnings. We want to offset a little bit of the risk in those earnings. We want to allow us to have upside potential, of course, but if the stock drops, we want to have a little bit something to kind of soften the blow for us. So what we can do is we can buy a put option. Okay, well, what put option should we buy? So that's the obvious question. And so say earnings are coming up here around the December 1st, for example, just as an example. We might want to go out to this expiration series or possibly one of the ones after it. Let's just go with the 15 the monthly expirations instead of a weekly this time around. And let's just show all the strikes. There's going to be a bunch of them. Okay, so here's the option chain for Apple for the 15 December expiration cycle. And we see that Apple is currently trading at around 180. There's 176 is the last price. So 175, 180. These are 5-point wide strikes. And we don't have the delta over here yet. So what we can do is we can go to this Theo price, and then I believe down here to the option theoretical Greeks, and choose delta, and boom, we see the delta. It changes on the left and the right for the calls and the puts for this particular option chain. Okay, now I had mentioned that we might want to offset about 30% of the risk of our position. So that means we want to bring the option delta for our position from 100 down to around 70 or so. That'll knock off about 30% of our risk to the downside. Okay, so what we want to do is look for an option that's at around 30 delta. Well, there's a 43 delta, and then there's this 27 delta. That's pretty close to 30. So let's choose to purchase a 170 strike put in Apple. So we're going to click the ask price here in the Thinkorswim Analyze tab, and that will add one option to our simulated positions down here. Now remember, that was a 27 delta option. It's a negative because it's a put, and it's .27. A 0.27 is you just say this a 27 delta. You call that a 27 delta. Okay, and so take a look right here at the center price slice. Let's delete these additional slices. Once again, like I say, I could go over this risk array in a future video and talk about that. But this is exactly what our delta is at this moment now that we added the 27 delta to our position. Now our delta is 73. So we've decreased our risk by about 30%, 27% or so on this position. Okay, so that's one way that option delta can help us choose the correct option to build up a hedge for a position. Now, let's add another price slice in here, and let's take this guy up. Say Apple increases, let's just go up a dollar amount. Let's say Apple increases by, let's say $20. Okay, now it's moving, price would move away from our put in this particular case. And so since price moves away from our put, our delta decreases on the put, right? And now our delta becomes 98 in the overall position. If I uncheck the stock price over here, so it takes the 100 shares out of the equation, our delta for this one stock, this put, is now just 1.29. Remember, it's actually 0.0129 times 100, so we get 1.29, which this was our 27 delta at the money, right? It was 0.27 times 100, so our delta is negative 26. Delta, puts carry negative delta, so that's very interesting. Now, if we add another price slice in here and we go, let's go down. What happens if the price drops $20 due to our earnings, right? So in that case, the option, remember we just have the option selected at this time in our simulated position here. The delta of that option is now 87. So it's almost 1 for 1. Well, it's 13% less than the 100 delta for the stock, but we're getting very close to a perfect match with the stock. So as the price drops, and it continues to drop, the option delta increases in this put to offset the stock price, and eventually it becomes 1-to-1. Right? So now if we add our stock back into our simulated position here, we'll see that for a if the price of the stock dropped $20, our delta on the overall position would just be 12 now. So that would mean that we would lose $12 in our account for every $1 drop in the stock price. Now, if we didn't have the option, we'd be losing $100 for every $1 drop in the stock price because of the 100 shares of stock, right? Well, because of that one put, and for the fact that the price moved in, the put became more in the money, and therefore its delta increased, it's now offsetting more and more of our position. Now we can take a look over here at the risk profile. This is the graph that you may be familiar with the options. And this is the risk graph of this overall profile, or this overall simulated position. And the blue line is at expiration, and the purple line is today. Okay, so you've got two different times on this one graph. So at expiration of the option, your stock isn't going to expire, but your option will on the 15th of December. You see that you have a coverage down to a maximum loss of $894 on the overall position if Apple drops. Okay, so that is at around 170, right? And that's at expiration. Now, this trails off if it dropped today, like at a big event, like say the earnings were tomorrow, then you're going to be covered a little bit more on the short term, right? You're not going to reach this maximum loss until way out here at 157. It might give you a little time to get out of the position or change it up or manage it in some position, or for the stock to rebound, right? So it buys you a little bit of time before your option expires down here. But in either case, your maximum loss on the position is $894, as the analyzer says here, at the option expiration on December 15th. So if the stock doesn't rebound above 170, the maximum loss on this overall position, which is your stock and the option together, you'd have to close both of them out in order to maintain this particular max loss. Once your option expires, then your stock's going to be in the open again, but you'd be in the money here anyway. So you would have to. So let's see here. So that's about that's the very simple case of how you can use option delta to hedge a stock position. So just a really quick recap: you take a look at the delta of your position and or of the option, and compare that with how much you want to offset your stock position against how many shares of the stock that you have. Now, things can get a little bit more complicated if you don't have an equal number of 100 shares, and we can talk about how to handle that in a future video if you're interested in that. And once again, leave me a question or a comment down below the video, and we'll get to that. And that's another very interesting case in how you can hedge a number of shares that is not your prototypical 100 share block. Apple's $176 stock, and you may only have 10 shares, or you may have 5 shares. Well, you can most likely hedge that in some way. The 5 shares is kind of low, but if you've got 52 shares of stock, you can hedge some of that off with an option. And so we could talk about that. Anyway, so that's the first part in one of the 3 ways that option delta can save your bacon. So if you're interested in the other 2 ways, or any other videos we have coming up, or anything that I had mentioned that you might like some additional videos on, be sure to leave comments, hit the subscribe button, and I think the little bell next to the subscribe button, so you'll be notified whenever I post up a new video, and I'll try to get those out ASAP. And good trading. Talk to you later.